Hello friends, I am Dr. Manasi Kurtukoti and
I am Dr. Kishore Nikam.
today's topic of discussion is role of commercial banks in money supply. Sir, to begin with, we will have to understand about commercial banks.
Yes, a banking system of a country is a mirror of its performance. It comprises of central bank, commercial bank, cooperative banks, regional rural banks and non-banking financial intermediaries. Commercial banks are an important component of banking system. A commercial bank is a bank or a financial institution that performs two main functions, namely accepting deposits and giving loans. Besides, it performs other functions too.
Like it offers checking account services, makes various loans and offers basic financial products like certificate of deposits and so on and so forth. The commercial banks offer variety of loans like mortgages, auto loans, business loans and personal loans. Commercial banks create loans out of deposits. There are four types of deposits, namely current deposits, saving deposits, fixed deposits and recurring deposits. Customers who deposit money into these accounts effectively lend money to the bank and are paid interest. However, the interest charged on deposits is always lower than that charged on the lending rate. The working of a commercial bank depends on its net interest income.
Net interest income is defined as the difference between the amount of money earned by a commercial bank by charging a rate of interest on loans or interest on a lending rate of interest, or the interest it pays to its customers on the deposits or deposit rate of interest. Here the point to remember is, though there is safety of the deposits with commercial banks, but they pay a very low interest rate on deposits as compared to other investments like mutual funds. Sometimes the rate of interest paid is 0, like that on current account deposit. Thus, in short, commercial banks are those banks that accept deposits and create loans out of deposits.
Though the main function of commercial banks is to accept deposits and advance loans, but with growth and development of the economy, banks have to perform many other functions like phone banking, issue of debit and credit cards, net banking, offering ATM facilities, sending SMS alerts, NEFT, that is National Electronic Fund Transfer, RTGS, that is real time gross settlement, etc. One of such important function is to help in creation of money supply. Before going into details, first let us understand the meaning of money supply.
The supply of money is the total stock of money in form of paper notes, coins and demand deposit of bank in circulation, which is held by the public at any particular point of time. The stock of money held by government and the banking system are not included because they are suppliers or producers of money and cash balances held by them are not in actual circulation. In short, money supply includes currency held by public and net demand deposits in banks. There are three main sources of money supply. First,
the first one is the government, which issues notes of smaller denomination like 1 rupee notes and all other coins. The second source of money supply is RBI, which has monopoly of note issues and thus is the sole issuer of paper currency, generally named legal tender money. The third money suppliers are commercial banks, which create credit on the basis of demand deposits. The review of the lecture till now is that commercial banks perform two main functions, mainly accepting deposits and advancing loans. While advancing loans out of the deposits, their role is to create money in the economy or act as supplier of money. As Professor Sayer has rightly said, commercial banks are not merely purveyors of money, but also manufacturers of money. Like Professor Sayer, there are many economists like Professor Keynes, Halm, Leif Cannon and others who agree that commercial banks do create credit. So, we have to first understand the meaning of the word credit.
Credit means trust, belief or reputation. It also means postponement of the payment to some future date instead of present. It is defined as an exchange which is not complete till the expiry of a certain period of time. Thus, credit involves three essential things: 1. Exchange of transfer of value, 2nd, time and 3rd, the confidence both in the integrity and in the capacity of the borrower. Similarly, every credit involves transfer of value.
For example, Sir sells his produce to me and I promise to pay after I sell the goods to someone. Here, it is just a transfer of value for some time. Credits are of various types like commercial credit, industrial credit, personal credit, so on and so forth. This classification of credit depends on the usage the credit is being put to.
For example, the credit is being used to purchase a machine, then it is called as an industrial credit. If a producer has borrowed goods and services on the basis of some promise to pay the money at some stipulated time, then it is called as a commercial credit.
If the same instrument can be used to take credit from a bank, then it is called as a bank credit. There are various instruments of bank credit like checks, bills of exchange, etc. Commercial banks can use any of these instruments to create credit. This process of creating credit with the help of credit instruments is called as the process of multiple credit creation. This process is based on some assumptions.
The first assumption is that there exists a banking system. For bank credit to be workable, there should be a banking system working in the economy. The country may follow any system, that is unit banking system, wherein the whole economy has one bank without any branches, or branch banking system wherein there are banks with its branches. Best example of branch banking system in India. Thus, system is not important, existence of bank is important. So, the credit instruments can be aptly used. In absence of these facilities, the credit creation process cannot materialize.
Another assumption of credit creation process is that the institutions that are doing business of banking and are helping in the monetization of the credit instrument should have legal sanction to do so. This is a must, because only if there is a legal backing, people will have faith in the banking system. To build this faith in the public, every country therefore has a banking legislation on its statute books which governs the business of all types of banks.
The next assumption is that the business should be of organized character. The credit is required generally by trade, industrialists or by people who are doing some kind of business. But at such economic activity or business should be organized. Okay. And that means that it has a well defined process. The firms are interlinked with one another in a number of transactions, or there is some common link between them, etc. This helps in building a trust between the business community and bank.
Another assumption essentially for credit creation process is existence of a well developed money market. The ability of credit creation of bankers depends on availability of credit instruments like bill of exchange, call money, etc. Without these credit instruments, it will be very difficult for the bank to create credit. Hence, existence of developed or underdeveloped money market becomes a precondition to the credit creation process to take place.
The last assumption of the process is existence of a well developed state of trade and commerce in the country. Only if the trade and commerce is developed, there will be need of credit and commercial banks can create credit. In short, for credit creation process to operate, two preconditions are: one, existence of deposits, and second, demand for credit. The reason for this is banks are going to create credit, but of deposits received by them. These deposits are of two types: primary deposits or passive deposits, and derivative or active deposits.
If I go to the bank with certain amount of hard cash or a draft or a check, open an account, a deposit is created, and this deposit is called as the primary deposit. It is also called as passive deposit. This is so because bank merely accepts the deposit as a spectator. It does not have any role in the amount of the deposit or on the number of customer, etc. One more reason for these deposits being called as passive deposit is they do not add to the existing stock of money supply.
The second type of deposits is derivative or active deposits. They are called as derivative deposits because they are derived from primary deposits. Banks gives loans, and while giving loans they create new deposits, hence these deposits are called as active deposits. While doing so, they add to the existing stock of money supply, hence they are also called as active deposits. Banks advance call loans to share brokers or loans to customers or to merchants. These loans are advanced on the condition that they are to be returned when demanded.
Suppose sir is a share broker and wants advance loan of 1 lakh from Bank of Maharashtra. The amount is credited to his account. Now, when he purchases shares, he makes payment by issuing checks against his account in the bank. Further, suppose he pays a check of 60,000 to one seller and 20,000 each to other two sellers of the shares. These sellers will deposit these checks in their banks. If they have the account in the same bank, that is Bank of Maharashtra, the Bank of Maharashtra's deposit will increase, or if they have account in some other bank, deposits of those banks will increase. In this way, deposits of the banks increases due to banks advancing loans to borrowers.
Similarly, bank advance loans to their customers by discounting or purchasing hundis or bills of exchange. For example, if a bank purchases bill of exchange of 50,000 from Pratik, then bank will issue a check in favor of Pratik, who will deposit the check in the bank in which he has an account. If it is the same bank, then the bank's deposit will increase or deposit of some other bank will increase. In both the cases, loans increase deposits. A bank also advances loans to merchants or manufacturers. While doing so, it follows the same procedure. It issues checks that increase the deposits. So, till now we have studied that banks accept deposits, and out of these deposits they create loans. Therefore, every deposit creates a loan.
While creating loans, they increase deposits and add to the existing stock of money supply, and hence it is aptly said that every loan creates a deposit. From the discussion till now, it is evident that every deposit creates a loan, and in turn every loan creates a deposit. While doing so, a bank cannot use all the money of the depositors. This is so because If the depositor wants to withdraw from their account, bank has to give them in cash. Hence, all the banks always keep some money in the form of liquid cash with them from the primary deposits, and the remaining amount is used in credit creation.
The central bank of the country fixes this proportion of liquid cash to total deposits to be kept by every commercial bank, and this is known as the cash reserve ratio and is a precautionary measure taken by the banking system. Now, let us see the technique of multiple credit creation. For this, we will have to assume that there are various banks like A, B, C, D, etc. having independent customers with them. Every bank has been instructed by the central bank to keep a cash reserve of 10%, and bank A gets a reserve of 2000 from a customer. Every bank has to maintain a balance sheet wherein this new deposit of 2000 will go as liabilities, as the bank have to give back the amount to the depositor, and the bank has an asset of rupees 2000 too, as it can create money worth that amount. This 2000 will be used by the bank to create loans, but it cannot use the whole amount as the CRR is 10%. So, 10% of 2000, that is 200, will be kept as CRR, and the remaining 1800 will be used in creating loans.
So, let us say a person X receives loan from bank A and pays off to some person through check. This person has account in bank B wherein he deposits the same check. Now, bank B has an asset of rupees 1800 with it. Out of this amount, it will keep 10% as reserves, and the remaining amount will be used to give loans. So, the amount remaining with the bank is 1800 minus 180, that comes to 1620. So, original amount is actually 2000. From it, bank created money of rupees 1800. Now, bank B will give loan of rupees 1620 to person Y, who issues check to person Z. Suppose person Z has an account in bank C, then it will get a new deposit of rupees 1620, which again will be utilized to give loans. Thus, new money will keep on getting created by the banks till the original amount is completely exhausted. So, 2000 plus 1800 plus 1620 plus 1458 etc. is created from 2000. This process of creating new money out of the deposit is called as the process of multiple credit creation. If the process continues till the primary deposit is completely exhausted, then the banks create an amount of rupees 20,000 from an amount of rupees 2,000.
This can be calculated with the help of a formula of the multiplier, which is K, that is the multiplier is equal to 1 divided by R, that is reserve ratio. So, in our example, it will be 1 divided by 10%. The value of K will be 10. So, the total amount of money created by banks will be K multiplied by the primary deposits. So, in this case, it will be 10 multiplied by 2000, that is 20,000. If the cash reserve is 20%, then the value of K will be 5, and the amount of loan created will be 5 multiplied by 2000, which comes to 10,000. This means that the higher is the cash reserve ratio, lower is the amount created by the commercial banks. In this way, banks will always create money more than the primary deposits created by the customers.
But there are some limitations to this process. First limitation is the total amount of cash received by the banks. If the amount of money supply in the economy is less, then the cash received by the bank will be less, which will set a limitation to the credit creation process. Another limitation is the cash reserve ratio. It is decided by Central Bank of the country. If CRR is high, then the money created by the banks will be less. Another limitation of credit creation is the cash drain. If depositors and borrowers are used to cash transactions, then the demand for cash will be high and money creation process will get obstructed. Another limitation of the process is banking habits of the people. If usage of cash in the economy is very high, then there will be constant withdrawals and banks will have to keep high reserve that will result into low credit creation.
The controls imposed by the Central Bank of the country in the form of qualitative and or quantitative credit control methods can restrict the credit creation by commercial banks. The number and amount of credit instruments available to the banks will determine the amount of credit creation. Higher the number, higher will be the credit creation. Similarly, the condition of trade and commerce or the phase of trade cycle in the country is going through will determine the amount of credit created by commercial banks. During recessionary phase, demand for loans will be less and hence credit creation will also be low. One more limitation can be existence of clearing house facilities in the economy. If the facility is available, then issue of checks and clearing of them will be easy and credit creation will increase and vice versa.
To conclude, we can just say that commercial banks are the money suppliers in an economy through credit creation. Thank you.
Thank you.